In the last quarter, a handful of wealthy individuals reportedly sold $47 billion of US stocks to buy gold. That data point, accurate or not, has captured headlines. Here at Finance Saga, we believe that to understand the future, you must follow the core mechanisms of finance, not just the sensational headlines. That $47 billion stock sale is a distraction. It's a rounding error compared to the multi-trillion-dollar structural shift happening one level deeper in the system, in the market that truly governs the price of all assets on Earth. The real story is not about private billionaires selling equities. It's about public central banks quietly but persistently selling US Treasuries. This is not a new trend, but it has reached a new, critical velocity at the precise moment the US government's borrowing needs are exploding. The fundamental tension is this: the US Treasury must issue over $2 trillion in new debt this year to fund the deficit. For the last 2 decades, the most reliable, price-insensitive buyers of that debt were foreign central banks and US commercial banks. Today, both of those core buyers are stepping away. This isn't a forecast of a crash. It's an observation of a fundamental breakdown in the system's demand structure. The question is no longer if this will have an impact, but who will be forced to absorb this supply and at what price. To understand the consequences of this shift, we need a simple map of the global financial plumbing. It's a 3-part flow that dictates the availability of money worldwide. First, you have the funding sources. These are the massive, stable pools of global capital. Think foreign central banks like the People's Bank of China and the Bank of Japan, who hold US dollars as reserves, or major US commercial banks. Second, you have the intermediary. This is the core plumbing itself, the US Treasury market, where this debt is auctioned, and the critical repo market, which functions as the system's high-speed pawn shop, allowing institutions to exchange treasuries for overnight cash. Third, you have the macro outcome, the cost and availability of US dollars for everyone else, which in turn sets the price for 30-year mortgages, corporate loans, and emerging market debt. For 20 years, this mechanism was a virtuous cycle. Foreign nations earned dollars through trade, parked those dollars in treasuries, which funded US deficits and kept global interest rates low. We have seen this mechanism break before, but for different reasons. The 2008 Great Financial Crisis was a failure of the intermediary. The funding sources, the banks, were still there, but the plumbing itself clogged. The collateral being pledged in the repo market, primarily private label mortgage-backed securities, was suddenly revealed to be toxic. Trust evaporated. No one knew what their counterparty's collateral was worth, so lending froze. The macro outcome was a catastrophic seizure in credit that bled into the real economy. The lesson from 2008 was that the quality of collateral in the plumbing is paramount. If the intermediary clogs, the entire system fails, regardless of how much funding is available at the source. But what happens when the plumbing itself is fine, when the collateral is pristine US Treasuries, but the primary funding source simply turns off the tap? This is not a hypothetical scenario. We have a precise historical precedent for this exact type of shock. A moment when the mere hint of a key buyer leaving the market sent global yields into a panic. This event didn't involve toxic assets or bank failures. It was a crisis of expectations, a sudden repricing of who, exactly, would support the market. This 2013 taper tantrum provides a far more accurate blueprint for the pressures building today than the 2008 crisis ever could. It demonstrated that the stability of the funding source is just as critical as the quality of the intermediary's collateral. And as we'll see, the buyer who stepped away in 2013 was the US Federal Reserve itself, creating a vacuum that dragged global markets down with it. Now, that vacuum is being created not by the Fed, but by the rest of the world. The 2013 taper tantrum was a dress rehearsal for the problem we face today, but with one crucial difference. In 2013, the buyer who stepped away was our own central bank. After the 2008 crisis, the Federal Reserve had initiated quantitative easing, or QE, becoming the largest, most predictable buyer of US Treasuries. By May 2013, it was absorbing $85 billion a month. This policy, a form of funding source intervention, had successfully suppressed long-term interest rates. But when Chairman Ben Bernanke merely suggested the Fed might taper or slow down those purchases in the future, the market reacted instantly. The mechanism was pure price discovery. If the single most dominant, price-insensitive buyer was leaving, the market would need a much higher yield to attract new, price-sensitive buyers to absorb that same supply. In the following 8 weeks, the 10-year Treasury yield, the benchmark for global borrowing, rocketed from 1.6% to over 2.7%. The macro outcome was immediate. Capital fled emerging markets in a panic, and the cost of US mortgages spiked. The lesson of 2013 was clear. The expectation of a major funding source vanishing is enough to trigger a global repricing of risk. We saw an even more violent test of the system in March 2020, but this event serves as our crucial counterexample. During the initial COVID-19 shock, the world didn't just need dollars, it needed them immediately. This dash for cash created a perverse reaction. Everyone, including foreign central banks, began selling their safest assets, US Treasuries, to get their hands on liquid currency. It was a 2008-style intermediary failure, but worse. The risk-free Treasury market itself became illiquid, a scenario previously considered impossible. Treasury International Capital, or TIC, data showed foreign officials dumped a record-breaking $300 billion of US debt. But the system didn't collapse. Why? Because the Federal Reserve deployed a nullifier. It activated 2 critical safety valves. First, it opened unlimited US dollar liquidity swap lines, allowing foreign central banks to get dollars directly from the Fed without having to sell their treasuries in the open market. Second, it launched the FIMA repo facility, a permanent pawnshop where foreign official institutions could post their treasuries as collateral in exchange for cash. This brings us to our second, more evolved view of the global plumbing. The map is the same. Funding sources flow to the intermediary, which determines the macro outcome. But now, the Fed has attached 2 massive emergency pipes, the swap lines and FIMA facility, that bypass the public market entirely. They connect the Fed's balance sheet directly to the funding sources and the intermediary, acting as a pressure release valve to prevent the system from exploding. This 2020 counterexample proved that the Fed has the power to nullify an acute liquidity crisis. It can fix a sudden, panicked dash for cash. But this raises a much more difficult question. What happens when the problem isn't a temporary panic, but a permanent, structural shift in demand? The tools that fixed the 2020 heart attack are ill-suited for the chronic condition developing today. What we are witnessing now is not a 2020-style panic. It is a 2013-style shift, but on a larger scale and with no clear end. Foreign central banks are not panic selling. They are strategically diversifying. They are not dumping treasuries in a single day. They are quietly, persistently reducing their holdings, month after month, quarter after quarter. This slow-motion exit is driven by deep structural incentives, not by temporary fear. They are diversifying their reserve heavies, a trend accelerated by geopolitical tensions and a desire to reduce reliance on the US dollar. This gradual, structural bleed is creating the same supply and demand vacuum seen in 2013. But this time, the US deficit is multiples larger, and the buyer who is leaving isn't the Fed. It's the rest of the world. This chronic problem cannot be solved by a temporary liquidity injection. It can only be solved by finding a new, permanent buyer, and that new buyer will demand a different price. The evidence for this shift is no longer hypothetical. It is now appearing in 3 specific, measurable signals from the market's core. These signals from the market's core are no longer ambiguous. They are quantitative and structural. The first and most important signal is from the Treasury International Capital, or TIC, data itself. This is the official ledger of who is buying and selling US assets. For the last decade, it has shown a clear and accelerating trend. Foreign official institutions, the central banks and sovereign wealth funds, are no longer net accumulators of US Treasury debt. This is a profound regime change. China's holdings, for example, have fallen from a peak of over $1.3 trillion to levels not seen in over a decade, now well below 800 billion. But this is not just a China story. Japan, the largest foreign holder, has also been a persistent net seller, often forced to sell its US dollar assets to generate cash to defend its own currency, the yen, from collapsing. This isn't a panicked 2020-style dash for cash. This is a deliberate, long-term strategic diversification, compounded by domestic policy needs. This persistent selling, or even just the refusal to reinvest maturing bonds, removes the single most reliable, price-insensitive buyer from the market at the exact moment the US Treasury is dramatically increasing its supply. The second signal is the persistent cost of US dollar funding in offshore markets. The cleanest measure of this is the cross-currency basis swap. This is a niche derivative, but it's a critical vital sign for the global plumbing. In simple terms, it measures the premium or discount an institution in, say, Europe or Japan must pay to swap their domestic currency for US dollars. For most of the last decade, this basis has been negative, meaning it costs extra for a foreign bank to get its hands on dollars. When the system is stressed, as it was in 2008 and 2020, that negative basis explodes, and the cost to borrow dollars becomes prohibitively expensive. Today, we are not in a crisis, yet that basis remains stubbornly wide, far from the zero bound that would imply healthy, frictionless markets. This tells us there is a structural, underlying shortage or mispricing of dollars in the global system. The Federal Reserve's swap lines, our 2020 counterexample, act as a cap on this. But the fact that the market is constantly straining against that cap signals a deep and persistent imbalance. The world still needs dollars, but the mechanisms to get them are becoming more expensive and fragile. The third signal is perhaps the most immediate: the deteriorating health of the US Treasury auction itself. If foreign buyers are gone, who is left? The other traditional buyer was US commercial banks. However, post-2008 regulations, chiefly the supplementary leverage ratio or SLR, make it costly for these banks to hold massive amounts of low-yielding treasuries on their balance sheets. From a regulatory standpoint, a treasury bond and a risky corporate loan consume balance sheet capacity in a way that makes the treasury less attractive. We see the result of this bank-level reluctance in the auction data. When the Treasury auctions, new debt analysts watch two numbers: the bid-to-cover ratio, which measures total bids versus the amount of debt being sold, and the auction tail, which is the gap between the average accepted yield and the highest weakest bid the Treasury was forced to accept. In recent quarters, these metrics have shown consistent weakness, particularly in longer duration bonds. Bid-to-cover ratios are trending down, and auction tails are growing larger. This is the market's way of saying that demand is thin, and the Treasury is having to pay a significant premium to find a new marginal buyer. This leads to the most important question of this new regime. If the two most stable, long-term, price-insensitive buyers, foreign central banks and US commercial banks, are both structurally impaired, who is absorbing the $2 trillion in new US debt? The answer is a different, less stable cohort: price-sensitive, opportunistic, fast money buyers. This includes hedge funds, money market funds, and retail households. Money market funds will only buy very short-term T-bills, creating a glut of demand at the front end of the curve while the long end starves. Households are fickle. This leaves hedge funds and other relative value players as the new marginal buyer for 10 and 30-year bonds. Unlike a central bank, which buys for policy reasons, a hedge fund buys only if the price is attractive. They demand to be paid for the risk. This means the era of suppressed volatility and negative Rebum term premium, the extra yield you get for holding a long bond, is over. The system has been replumbed in real time, away from stable, long-term holders and toward opportunistic, short-term investors. This new structure hasn't been tested in a real crisis, and it creates a specific, quantifiable set of conditions that lead to a market break. It's time to define the if-then thresholds that signal the true breaking point. This new market structure is inherently fragile, and it recalibrates the entire financial system around a new, higher baseline for volatility. This is the final and most important evolution of our mechanism map. The funding sources are no longer the stable, price-insensitive central banks. They are now price-sensitive hedge funds, money market funds demanding high short-term yields, and domestic retail buyers. The intermediary, the Treasury and repo market, remains the same plumbing, but it is now under immense pressure to handle larger volumes from less stable participants. This leads to a new macro outcome. The system requires a structurally higher term premium. The term premium is the extra compensation investors demand to hold a long-term bond instead of just rolling over short-term bills. For the last decade, it was often negative. Investors paid for the safety of US debt. In this new regime, the term premium must be positive and volatile, because it is no longer a payment for safety. It is a payment to hedge funds for warehousing the government's duration risk. This allows us to create a quantified if-then funnel to identify the true point of systemic stress, moving beyond vague headlines. This is not a market timing tool, but a framework for measuring the system's stability. Our base case, with roughly 70% confidence, is that this new mechanism holds, but at the cost of higher baseline rates and more frequent mini-tantrums, like the one in 2013. However, the alternative case is a full-blown funding crisis. Here is the threshold. If the quarterly tick data shows net foreign official sales of US Treasuries accelerating past $100 billion, and this is met by a 10-year or 30-year Treasury auction that tails by more than 2 basis points, signaling a failure of the price-sensitive buyers to show up, and this coincides with bank funding stress, measured by the FRA-OIS spread, holding above 35 basis points for 2 consecutive weeks. Then we would expect a non-linear market event. This event would not be a 2008-style credit collapse, but a 2013-style duration panic, where the 10-year yield breaks upward, violently repricing all global assets from tech stocks to mortgages within a matter of weeks, regardless of what the Federal Reserve is doing with its overnight policy rate. The only nullifying condition for this scenario is a complete reversal of policy. The Fed would have to restart massive quantitative easing, effectively monetizing the deficit and becoming the buyer of last resort once again. This regime shift creates a new, clear-cut set of cash flow consequences, a new set of winners and losers. The group that pays for this new structure is, first and foremost, the US taxpayer. Every auction that clears at a higher yield is locking in a higher interest expense on $35 trillion of national debt, diverting future tax revenue from services to bondholders. The second group that pays is the US homebuyer and any corporation rolling over debt. Mortgage rates are now unanchored from the Fed's policy rate and are instead tied to the volatile term premium demanded by hedge funds, meaning borrowing costs will remain structurally higher. The group that benefits is simply the new marginal buyer. Capital is now being paid handsomely to do a job that foreign central banks used to do for free. This includes the hedge funds capturing this new term premium private credit funds that can offer an alternative to volatile public markets, and even ordinary savers who through money market funds are finally earning a real yield on their cash. So that $47 billion sale of US stocks, it was a symptom, not the disease. It reflects a choice by a few private individuals to diversify away from a system whose core is undergoing a profound structural change. The real multi-trillion-dollar story is not that a few billionaires are selling, but that the world's governments have already left the building. They have been replaced by new, opportunistic buyers who demand to be paid for volatility. The 2010s were defined by central bank suppressed volatility and the endless hunt for yield. This new era will be defined by the return of volatility and the high price of funding. We are entering a regime where the mechanics of the Treasury and repo markets, the plumbing itself, will matter more for your portfolio than quarterly corporate earnings. The primary risk is no longer just a recession, it's a funding squeeze. And in this new system, the stability of that funding is now entirely dependent on the most leveraged, price-sensitive players in the market. This raises the most important question for our next analysis. What happens when those new buyers, the hedge funds, face their own liquidity test?